Hey everyone, happy Wednesday, November 26th. It's about 10:45 in the morning on the West Coast, and it's time for another market update. We'll come into a day earlier this week with Thanksgiving tomorrow. So happy Thanksgiving to you all. I hope you guys have a safe day with friends and family and have a great day. The markets, however, did get something to be thankful already this week, going back to last Friday. If you remember correctly, the narrative had kind of switched to no cut upcoming from the Fed. Basically any Fed voting or non-voting member that spoke kind of made it sound like they weren't in favor of a cut. However, on Friday, New York Fed President Williams came out and made it quite clear that he is in support of a cut. And the markets really reacted positively to this. And the reason is Fed President Williams and Fed Chair Powell are very close. So a lot of the markets are taking this as President Williams saying this is basically Chairman Powell saying this. So that was really positive for the markets. And then a little bit later, San Francisco Fed President Mary Daly, who also is part of this little cohort with President Williams and Fed Chair Powell, she also came out in support of a rate cut. So the markets reacted really positive to that. That kind of flipped the narrative. Going back to last Thursday when I did this video for you guys, the markets were at about a 35% chance they would cut in at December 10th, the Fed rate. Now it's up to 85%. So all it took, it wasn't new data. It was just, basically one of these powerful men in the Fed to come out and make this statement, and the markets are reacting positively. So that is something to be thankful for this week. Next thing we got. So first, the ADP, private payroll data has started coming out with this 4-week rolling average of job gains or losses that they've been releasing. So for this week, we got the data, the 4 weeks leading into November 8th, and that showed a loss of about 12,500 jobs per week. So that doesn't scream strength in the labor market. Don't want to see people lose their jobs, but like we talked about, any sort of weakness in the labor market is what the Fed is looking for to continue to cut rates. So that's what we want. So that was a positive thing. That showed that, again, the job market is not that strong. The next thing we got in employment numbers this week was unemployment claims. So new people filing for unemployment came in at 219,000 jobs, or new claims. The estimate was about 225,000. So this is still a pretty low number. However, continuing claims went up to about 1.99 million, which is around 2021 high levels. So, really, it continues to show, these unemployment claims continue to show kind of what the labor market's been like. It's, companies are a little bit hesitant to lay people off. But however, when people do get laid off, they're having a harder and harder time finding new employment. So again, doesn't really scream strength in the job market, but with those unemployment claims still being pretty low, that's keeping things a little under control, not as much of a freak out about what's going on there. Next thing we got. So we got some backlog data. So again, after this Fed shutdown, now back open, we're starting to get some of this data that we didn't get while the government was shut down. And first thing we got was PPI, so producer inflation. That came in lower than expected. The headline came in as expected. It was up 0.3% month over month for October. However, the core, which takes out in food and energy costs, that came in lower. It came in at 0.1% gain when it was supposed to be about 0.2. So again, inflation coming in as expected or lower is something we want to see. The lower inflation is, the better chance, again, the Fed will cut their rates. The next thing we got was retail sales for the month of September. So this is how much as Americans were spending money. Again, this is for September, so it's a little old data, especially as we get close to the holidays. That will probably tick up. But that came in at about 0.2%. Expectation was 0.3. So, not a big difference, but still a little bit of a positive there because, again, the more we're spending money, generally higher inflation goes, and the less likely it would be that the Fed would cut their rate. So next thing we got, September appreciation. So again, this is the Case-Shiller. This is the kind of the gold standard for appreciation in this country. And again, this is national. This isn't for certain areas. This is an average across the country. And month over month seasonally adjusted came in at 0.2% gain in September. However, non-seasonally adjusted down about 0.3%, and that leaves us year over year at 1.3% gains. So again, not deflation. Someone that bought a house a year ago, on average has gone up a little bit over 1%. But again, it's definitely slowed down. You can see each month we're getting a little slower, 1.9 to 1.6 to 1.4 to 1.3. So again, this is very closely tied to what's going on with mortgage rates. Obviously not as many people are in the market to buy homes. That's not pushing prices up as much. So again, good to see that there is still appreciation. It's not depreciation, but definitely slowing down. Next thing we got was October pending home sales. So we did get a small increase here, and it's actually the third straight month these have increased. It was up 1.9% month over month, was expected to be about a half a percent. Year over year, they're still down 0.4%. And then I'll get myself out of the way here, but the current sales pace is at about 4.1 million homes sold per year. An average, in the market is about 5 to 5.5 million homes sold per year. So obviously still way below that. But it's good to see that this has ticked up, and we should kind of expect it to continue to go up as mortgage rates come down. Obviously, the more rates come down, the more people will be in the markets, more people are willing to sell their homes, and more sales that will go final. So, again, good to see it's coming up, but still it's at lower levels than we would like for over a year now. Next thing, where does that leave us? So going back to last week, the average 30-year conventional rate, according to a lender survey, so not us, but across the country, all these different lenders, came in at 6.36 was the average. Today we're down to 6.22. So again, like I said, New York Fed President Williams last week, making those comments really turned things around because we were starting to tick back up, getting close to 6.4. So good to see that as we head into that December, meeting coming up December 10th. Before that meeting on December 10th, next Wednesday, we get ADP's monthly employment numbers, so that will be important. We get PCE inflation, the Fed's favorite form of inflation, next Friday. We will not get the BLS jobs report until the 15th. So those are, besides these other reports we get every week, those two reports, the ADP and the PCE, are probably the two most important ones we'll get before the Fed has their next meeting and makes their next rate cut announcement. Like I said, right now it's about an 85% chance they cut rates, 15% chance they don't, up 50% from last Thursday when we spoke. So let's hope that trend continues and that gets stronger and stronger as we get closer to December 10th. Because again, we want the Fed to cut rates because it doesn't directly tie into mortgage rates, but it will continue to help mortgage rates as that Fed rate comes down. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, I hope you guys have a great Thanksgiving and we'll talk soon. Thanks a lot, guys.